So what is the federal estate tax? Well, it's a tax on your right to transfer property at death. Now that's taken out of the tax code, and that's a great definition that the federal government created. Who would have known that you had to pay a tax at that point? Well, you might not have to, and so we'll talk about it. How do you calculate it? It's very simple. Add up everything you own or have an interest in. This could include the ranch, you know, that could be very, very valuable, but it could include a life insurance policy that the decedent owned, okay, so the decedent controlled it, but the decedent nor the beneficiary or the decedent has no, the decedent is dead. He doesn't have a benefit of that policy. It goes to somebody else. So let's say single landowner names the kids as the heirs to his estate, but he wants to make sure they're also provided for, so he takes out an insurance policy on his life, names them the beneficiaries. That person passes away. That insurance policy is included in his estate for estate planning purposes. This could push the policy beyond the threshold to create a federal estate tax liability. So the first major principle is that between spouses, you can transfer an unlimited amount, either at death or while you're alive, and there's no tax liability, no penalty. Spouses have this right. And so people often think that, well, I don't really need to do anything to avoid this tax because there won't be any tax. Well, there won't be at the first death, okay? But unless there's a new spouse in the picture pretty quick, then what that does is it moves the assets, which were owned by husband and wife, now automatically the surviving spouse, and that's usually the wife, is going to own 100% of that asset. And so what this does is it increases the size of her estate, could push her over that threshold and create more of a federal estate tax liability at the second death. So this isn't so much a tax avoidance principle as it is a tax postponement principle. Here's a second major principle. And this is where the law has significantly changed. Every individual has this federal exemption. Sometimes it's referred to as a credit, such that you can pass, according to the new law, up to $5 million to anyone, non-spouse, right, without paying federal estate tax. This could be a transfer during life in terms of a gift, or it could be a testamentary transfer, a transfer that's made at death. So you can pass up to that amount without any tax. The Taxpayer Relief Act at the end of 2012 indexed this amount to inflation and made it permanent. So it's $5 million now going forward. It's not going to change unless Congress, you know, does something strange again. It's not floating. It's not adjusting every year, every other year. But it is indexed to inflation. So this year, in 2013, it's $5,250,000. So you can expect next year that's going to go up incrementally. So this exemption amount is personal to the individual. It applies to transfers to non-spouses, because remember, between spouses, there's the unlimited marital deduction. So if you put both married couple, both husband and wife together, they can pass a total of $10,500,000 in 2013. Again, that amount will increase slightly. So if the ranch with the easement on it is less than that value, and that's the principal asset in the estate, then it's very likely that a very simple estate plan for that couple will avoid federal estate tax, and you know, things will just continue to roll on. There won't be any sort of liability at the second death. Now, one of the things that the 2012 Act also made permanent was the portability, it's referred to as in a code, portability of any of the decedent's unused exemption at the first death to the surviving spouse. So spouses now, so get this, it used to be use it or lose it. Husband died. If he didn't give that $5 million to the kids in a trust or something, and everything passed to the spouse under the unlimited marital deduction, that credit went unused. Okay? Now at wife's death, the second death, all she has is her credit. That was the example we used before. Now what you can do, between spouses is transfer the unused exemption amount. So that now at the second death, wife has her $5.25 million and the decedent's $5.25 million. So this is something new, and this will ease a lot of the planning for many families, but there still might be important and useful reasons to use exemption planning and use trust at the first death. So I want to talk about this portability because, again, this is something that is an important part of this conversation with landowners. The exemption portability applies between spouses only, and the last spouse controls. In other words, husband dies, and he's got an exemption amount, but wife remarries. Okay, well, the second spouse's exemption amount is what controls, not the first. She gets married 7 times, it's the 7th husband. Whatever exemption amount he has, that's what she has at her death. You can elect the full exemption amount or a partial amount, but it does require the filing of a 706, this estate tax return, at the first death in order to quantify the amount of the exemption that will be transferred to the surviving spouse. If you don't file the 706, the exemption doesn't automatically transfer. So this is going to lead to a lot more filing of 706s in the future in order to lock in this exemption amount. And there are also tax implications for using the exemption amount, which I won't go into. I'll just point that out to you. So with regards to capital gain tax and the sale of assets. Well, let's just bring this home now with an example very quickly. This is the poor planning ranch, all right? So these are land-rich, cash-poor clients, landowners. They've got a very valuable piece of property. It's about 1,000 acres up on the Pedernales River. And actually, that $12 million should be $15 million in that case. But they have this ranch. It's the family ranch. It's been in their family for a long time. They got some cash that if they scraped up everything, sold stuff, they could probably come up with $1 million in liquidity. They have this exemption amount. Husband and wife have each this exemption amount. So what happens when the first spouse dies? Well, the first spouse can shield under the exemption $5.25 million. Their estate's bigger than that. The decedent's estate is bigger than that. So the estate would technically be taxable, but because everything was given to the surviving wife under the unlimited marital deduction, there's no federal estate tax. Hooray. But the poor planning folks did not file the 706 at the first death, at husband's death. And as a result of that, the husband's exemption amount goes unused. It's not portable to the survivor. So what happens at the second death then? Wife shortly joins husband in the great beyond, and kids are left to tally up the size of the estate. Well, $12 million ranch and $1 million in cash, but they can only use mom's $5.25 million to shelter from the estate tax. So that means there's a taxable estate of almost $8 million. Let's run the numbers. We're using a 40% federal estate tax on every dollar over that exemption amount of $5.25 million. What does the IRS get? $3 million. Well, how is this family going to pay for that federal estate tax when they only got $1 million at best in liquidity? If the ranch is under an easement and it provides for a subdivision, guess what's going to happen? They're going to have to exercise a subdivision right and sell off a portion of that ranch in order to pay the federal government. So you can see where this would drive the exercise of reserved rights in that scenario. Well, let's say they had good legal counsel and they used the exemption amount. Now what they're working with is husband's exemption amount. The 706 was filed at husband's death, so wife has both exemptions. So at her subsequent death, they can shelter $10.5 million. That greatly reduces the taxable estate. Now there's only 2.5 million that is subject to this 40% tax. So run the numbers. The federal estate tax drops to 1 million. They might not have to exercise that reserved right. So you can see that the use of portability under this scenario saved over $2 million in federal estate tax. And that's why this is an important consideration to know about, and to maybe, as part of your overall discussion, if the landowner asks you, have you heard about this? You know, what'll happen when I die? How will this all work out? That might be an issue that will be important for you at least to understand, so that you can talk about it and spot the issue. Because about the only thing you can do in that situation is tell them you need some help. You need someone to help you plan, but there's ways around this.